Good morning, everybody. Today's March 20th. It's Friday. I'm Cameron Mealy and my partner Kelly Keenan. Most of you know that we do a regular monthly video update for our clients, and we wanted to do a supplemental video really to kind of talk about these unprecedented times and what we're doing from a portfolio standpoint really to manage the risk. I don't have much to offer on that front, so I'm going to let my partner Kelly Keenan, who is our Chief Investment Officer, really talk about what we've done over the last several weeks, what we continue to do from an equity side, fixed income side, and commodity side to make sure that our clients' portfolios are positioned properly and, more importantly, positioned for long-term success. So, Kelly.
Thank you, Cam.
Tell me about your magic. What have you been doing?
Well, it's really two pieces to it. One is the bigger picture, the longer term, what we've kind of how we've set ourselves up for it, and now kind of what we're looking at, what we're doing right now. Big picture, we've talked about it many times. What we've done over the last really 2 years is the movement on the equity side towards more quality-oriented stocks, stronger balance sheets. We've been in a long expansion. We knew at some point a recession was going to come down the line. You know, the baseline expectation was, hey, it's going to be a slow grind. The economy slows, we go into recession, come out the usual. That's kind of the baseline. But then again, we never knew when a shock would come. Obviously, the shock is here, and we're going to get thrown into a recession. Whether that's Q1, Q2, or Q2, Q3, looking more like Q1, Q2. We don't know yet. We won't know until late April, May, when it really started. But the reality is, this is probably going to throw us into a recession, almost most certainly, and we'll move on it and go forward. So our longer term position was stick with quality in stocks. On the bond side of the equation, we basically moved to government bonds, which has been a good move. Other bonds have held up very well until recently. The bond market's getting a little dislocated. Bids and asks are getting difficult. So on the trying to get out of anything but treasuries has been difficult. Fortunately, we haven't had to do too much of that. That was a good time for buying. I anticipate some changes on what we're doing on the bond side here over the next couple months. So big picture, where we're at, we were in the right spots. Our downside, except for on the really indiscriminate days where just everything went down, we're starting to see a little bit of dispersion now over the last couple of trading sessions where people are a little more selective in their buying and selling, which definitely will be to our advantage. But in general, we've held up better than the market on the equity side of the equation. We did buy some gold about a year ago. That's worked out pretty well. Gold's been volatile like the stock market, but in general, the trend has continued to be up. So that's been a good safe haven in the investment. We also have, in our growth with income portfolio, a position that was hedged equity fund. We moved to a different type of fund that does, put some, more downside cushion in, and, a different upside parameter. So I think that's helping cushioning our equity exposure also. So that's kind of where we are at and what we've done. In the short term, really, we've continued with our strategies, whether it's in the price potential dividend yield, where we continue to weekly rescreen the stocks, and based on the metrics, we've made adjustments to the portfolios. One that sticks out, I think it was last Monday. Boeing's obviously been challenged. The original intention was, ultimately Boeing's going to come out of this just fine. So we'd been holding it through most of this, and finally on Monday we decided to step away from Boeing, and it was probably a good idea because it got hit pretty bad. In its replacement, we put in Verizon, so that's been definitely an accretive trade that's worked out pretty well. Verizon, they've been challenged with the rest of the market, but in general, I mean, they definitely look good, and we've seen a lot better action in Verizon. The second day we did it, Boeing got slammed, Verizon went up, so that was a good move. But we'll continue to make those internal changes. Now that's portfolios in general. In looking at individual client situation, clients have been pretty calm through all this. We've had a couple people that have wanted to cut equity allocations. We really, in general, been more buyers, where we've been buying at good prices over the last couple of weeks. We put a lot of money to work. Very little money has come out of the market. And the key with clients, and especially people taking regular distributions, monthly distributions to fund their retirement and so forth, we've kept plenty of money in cash and bonds to be able to weather a downturn like this. So, in general, even though, hey, I'm down, well, when I talk with clients, yeah, you're down, but that's the stock piece of it. And we have enough either in government bonds or cash to continue making your monthly payments for the next 3 to 6 months if not longer. A lot of people, it's several years out.
And I think that's,
That's the key. We can ride
that's
through
the
the
important
downside
thing
and come back
about
up.
protecting your downside is that we are cognizant, because we manage money on a selective basis for a limited number of households, that we really know our clients, know their situations. So, clients don't have to call and say, we've got a college payment coming up next year, we got to start putting cash away. We're already doing that. And so it's that proactive management, whether it's managing your fixed income, knowing your cash needs, but also it's that proactive management of not just wanting to be in a basket of equities like a mutual fund, where you've got exposure to transportation, you've got exposure to hotels, you've got exposure to hospitality industry, all the industries that are now out of favor. We can selectively choose which equities we're in, why we're in them, and choose really the best of breed. And that helps weather the storm. And that's what we're here to do, is to prepare clients for the long term, but to weather the intermittent storms.
So we will, like I said, continue our strategies, developing a nice little list of probably new additions to the, some of the portfolios as the dust starts to settle out here. But, this is definitely a buying opportunity. Like Cam said, we didn't have any exposure to airlines or hotels. So nothing that we hold appears to be something that's at risk of an industry being completely restructured or businesses going out of business, 100%. So that's really where we're at today, and we'll continue to move along. For existing clients, if you know of and you're not sure of, hey, am I really in good shape? Do I have enough liquid reserves to get me through either monthly payments or bigger expense tickets that either we've talked about or things that have come up where, hey, we need extra cash? Definitely reach out, and we can get things positioned accordingly, or I can just assure you that, hey, we're set up for it, it's ready to go, and we have time on this. One note I will make is, we've seen a lot of downside up to this point. The amount, how much more we have, who knows? I don't think it's going to be a lot more than where we're at. And I think we talked about this on the last call, but we've seen big volatility both directions. We'll find a bottom here in the next several weeks. And really, I think the volatility will continue into earnings season, which will start, mid-April. Once we get into earnings season, I think, I really believe that the bottom will be found at that point in time. But just a lot of chop along the way. So that's, kind of what my thought process is. And the other point I want to make is, from a market standpoint, the market, definitely will bottom out and start moving up in advance of the underlying issue, in advance of coming out of a recession, in advance of, hey, the coronavirus is under control, there's vaccines out there, and the whole health issue has passed us. So the market's forward-looking anywhere from 3 to 6 months out. We're probably in that 6-month window from the underlying issue of recession or just the health side of it.
So thank you as always for your trust in us as your financial advisors. If you have any questions, please don't hesitate. These are unprecedented times. People are concerned, and if you want to talk, just to say hello, give us a call.